And the interesting part with the credit markets is they've really evolved over the course of the last 20 years and escalated over the last 10. If you thought about, historically speaking, the credit markets were really owned by the banking system. But over the last, call it 2 decades, you've seen more and more of that be distributed out into the public or private markets. So the visibility into the credit markets and the ability to reprice those at a faster rate is more visible to the world. So I do think it is embedded in the equity markets. The other thing is the composition of the credit markets is different today than, call it, the S&P 500.
Yeah.
So when you saw in 2015-16, the credit markets reacted pretty quickly because it was a heavy component of commodities or energy, where you didn't see as much in the S&P. But when you look at the last, or Q4 of last year, when you think about what's going on with global trade, the big global companies or S&P 500 companies, when you look at the U.S. high yield market or the U.S. loan market, it tends to be more like localized U.S.-oriented entities that are not as exposed to that supply chain.
But you think high yield bottoming on Christmas Eve is significant?
I think there's a variety of things that are significant going on, right? I think, the economy is cycling, and I would expect over the next couple of quarters for the economic data to continue to drift lower. Not fall off a cliff, but continue to drift lower. And I think that you're going to see that impact with regards to earnings. And there's a lot more noise that you can talk about in Q1 around the earnings side of things. That being said, I think there are 3 things that I look at are constructive from the credit markets per se. One is just the repricing, right? The repricing of risk, globally speaking, there's a lot more balance now in risk premiums. And I'd say number 2 is very important, is generally what I see as a shift in policy. And now they have to play through that, but obviously the Fed rhetoric of changing more towards data dependency, if they're willing to shift like they are in 16, if the data gets weaker, that's a very positive to where the market was pricing in Q3 of last year. And lastly, I would say is just as they said in JP Morgan, is the credit fundamentals are actually pretty good. When you look at the underlying earnings over the course of the last couple of years, many CFOs have been very, I would say, active with regards to their balance sheet. So there's not a lot of maturities over the next couple of years. So that means they can withstand, I would call it, volatility in the markets.
Yep.
Interest coverage ratios are high because earnings have been strong, spreads have been tight, rates have been low, so they've been able to refinance at low levels.
Yep.
We talk about there are no covenants in the market. So in general, from a low growth perspective that has volatility around it, the credit markets, broadly speaking, can withstand volatility around economic
I
data.
wonder if the stock market had just moved through its lows hard, would credit spreads have blown out based on it? They would have. So
Absolutely.
It is the stock market then.
They are absolutely correlated.
Okay.
And what we always say with regard to the credit markets is essentially you're investing in senior equity. And so we do like to think about the credit market as a way of balancing your risk between, I would call it, rate or interest rate sensitivity, as well as your equity risk.
I'm going to tell Fink you did great today. He's coming on tomorrow, so I'm going to mention you specifically to him tomorrow.
I appreciate that.
So look for something in the next check.
Okay, great.
Okay.